FY25 earnings conference call of Rishabh Instruments hosted by DAM Capital Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors. Thank you, and over to you, ma'am.
Yeah, good evening, everyone, and a warm welcome to the Q2 FY25 earnings call of Rishabh Instruments Limited. We have the management today being represented by Mr. Narendra Golia, Executive Chairman, Mr. Dinesh Muslikar, Whole-Time Director, Mr. Vishal Kulkarni, Chief Financial Officer, and Mr. Anand Zada, Finance Director, Lumel. At this point, I'll hand over the floor to Mr. Golia for his initial remarks, post which we'll open up the floor for Q&A. Thank you, and over to you, sir.
Thank you, Bhumika. Welcome and good evening, everybody. Thank you for joining us on this Rishabh Instruments Limited Q2 and H1 FY25 earnings conference call. Along with me on this call, as informed by Bhumika, are Dinesh Muslikar, Whole-Time Director, Vishal Kulkarni, Group CFO, and Anand Zada, Finance Director at Lumel, and our Investor Relations Advisors, SGA. We have uploaded the Q2 FY25 results and investor presentation on the stock exchanges, and I hope you had a chance to go through it. Otherwise, please have a look at it after the conference call. To start the performance, I would say Rishabh Instruments achieved a consolidated revenue of Indian rupees 1,824 million, which means 182 crores in Q2 FY25, an increase of 7.7% on a quarter-on-quarter basis. H125, the consolidated revenue remains flat on a year-to-year basis at rupees 3,517 million, 351 crores. Our electronics and instrumentation business aims to provide comprehensive solutions to clients who look for environment-friendly and cost-effective ways to measure, control, record, analyze, and optimize energy and processes. The business includes electrical automation products, metering, control and production devices, portable test and measuring instruments, which together have achieved a consolidated revenue growth of 13% in Q2 FY25 and 5% in H1 FY25 on a year-on-year basis. We are seeing a good demand momentum in the electronics and instrumentation business, both in India and Lumel SA, domestic markets as well as other markets. In Q2 and H1 FY25, our electronics business in Lumel SA, Poland, has delivered revenue growth of more than 25% on year-on-year basis. I repeat, in Q2, Lumel SA, Poland has delivered more than 25% year-on-year growth basis. Previously, Lumel SA had been awarded a project for the development of innovative control and protection devices for strategic areas of the energy industry and innovative technology for their production in February 2024. This project will be carried over the next 3 years and is based on a fully automated production process and quality control of services under the European Funds for a Modern Economy program. The electrical automation industry is rapidly growing in Europe in spite of subdued economic environment. This is supporting our Lumel SA performance and helping us gain market share, along with momentum on back of our expertise in providing value-added services across automation and turnkey projects. Moving towards the aluminium die cast, mostly serves the automotive and non-automotive sectors. We have strategically decided to concentrate more on the non-automotive business. As we stated in our previous earnings call, the European automotive industry is not in the best of shape, and therefore this decision. The performance in this segment remained flat on a year-on-year basis, while on the contrary, our margins have deteriorated in the automotive industry because of our inability to pass on the price increases to our EV OEM customers. Dinesh will talk a little more about it, but yeah, that is the reality. We have decided to phase out such non-profitable contracts of one of the 2 large OEM clients, and it has concurrently declined our sales in the automotive industry. by about 26% in Q2 FY25 over Q1 FY25. Means from the first quarter of this year to the second quarter, we are down by 26% due to this automotive industry change. While the non-automotive sales remain stable, resulting in overall drop in sales for aluminum die casting business by about 14% in Q2 FY25 over Q1 FY25. So from first quarter to second quarter, we have decreased by 14.6%, mainly due to phasing out of some automotive business, which we see is not profitable. On capex front, the construction work at the Nashik factory is shaping up well, and we believe that the construction will be completed by early 2026. The new 6-storied building will double our capacities across all core segments in the electronics and instrumentation business. With this, I now hand over the call to Dinesh Muslikar, who will take a little more on granularity of the two businesses, along with our strategy and highlights of the key operational performance. Lastly, I am thankful to our entire team of Rishabh Instruments, Lumal, V&A, and CFARM Tinsley, who have constantly supported us in our ambition to become the leading global energy efficiency solution company. Thank you, and over to you, Dinesh. Please carry on.
Thank you, sir, and good evening, ladies and gentlemen. We achieved consolidated revenue, as Mr. Golia suggested, of rupees 1,824 million in Q2 FY25 and rupees 3,517 million in H1 FY25. Both remain flat on a year-on-year basis at a consolidated level. The electronics and instrumentation business in Lumal SA, Poland, and Rishabh in India have helped us sustain through the uneven times. Lumal SA had a notable increase of 25% on year-on-year basis, both in a quarterly and half-yearly top line, while Rishabh India domestic business has expanded by about 10% year-on-year basis. There is a dip in Rishabh India exports business, particularly in Europe, but we are under negotiation for new orders and would be able to regain this market soon. And this European situation is because of the market condition that we have in Europe. On the other hand, Lumal SA has expertise in providing electronics and instrumentation products along with value-added services across automation and turnkey projects we take over. And these turnkey projects in the field of solar, radiation gates, and industrial automation continue to give us significant momentum in spite of sluggish demand in European region. Our electronics and instrumentation business, which includes electrical automation products, metering, control, protection devices, and portable test and measurement instruments, has delivered the revenue of rupees 1,217 million in Q2 FY25, registering a growth of 13% on a year-on-year basis, and rupees 2,210 million in H1 FY25, registering a growth of about 5% on a year-on-year basis. The top line of Rishabh Electronics business in India has degrown by about 6% year-on-year, both on quarterly and half-yearly basis. This is, as I said, mainly because of subdued export orders and demand scenario in certain economies like Europe. At the same time, in India, we are growing. The electronics business now constitutes approximately about 65% of our consolidated top line. So it's increasing. It used to be around 60. Now it has come to about 65%, whereas die casting is reducing and has generated above par growth, primarily supported by healthy growth in Lumal SA. The electronics and instrumentation business has also achieved steady and stable EBITDA margin between about 15% and 18%, both in India and Polish entities respectively. So on the electronics business, I repeat, our EBITDA margins are 15% in Rishabh and 18% in Lumal SA in Poland. We have also been able to successful in gaining strong momentum as we go forward with the solar string inverter business. This segment revenue has increased by 300% on a year-on-year basis in H1 FY25. We are putting a lot of efforts in improving operational excellence and cost efficiency to increase our margins. we have managed to cut production costs for solar inverters by about 5-6% to increase profitability. We need to achieve further cost reduction of about 10-15% to be very competitive in this very challenging market, which is dominated by Chinese inverters. We are certain that we will meet our goals and reach a 100 crore company in next 3 to 4 years time. Further, we plan to introduce new range of inverters from 2.5 kW to 6 kW to cater to deliver needs of our customers. Our solar business is steadily gaining momentum, and we are planning to develop a new generation of Neo 3-phase inverters and Uno single-phase inverters to align our products to various government solar schemes announced by Prime Minister's schemes to remain competitive in Indian market. We are further expanding our electronics manufacturing capacity by addition of state-of-the-art SMT, surface mount technology lines, both at Rishabh, India and Lumel, Poland, by end of this financial year, which will support us to grow in our electronics products, EMS and solar production. Moving forward on our die casting business, Lumel Alucast in Poland caters to two major industries, automotive and non-automotive. The automotive business, which represents about 50% of our die casting business, is undergoing transformation phase due to the automotive industry state in the whole European economy, as informed earlier. The non-profitable contracts of one of our two large OEMs are being phased out. With lots of efforts in the last 3 months since we had the last earnings call, we are able to find agreement on phasing out these loss-making projects, all of them from one major customer. This will happen in the next 2 to 3 quarters. We have also managed to get some price increases during such period of phasing out. So this should reduce our losses significantly in the next 2 to 3 quarters. So what we have done is, as a strategic plan, we are reducing non-profitable auto industry projects, and during this period, we also have increased some prices with our clients. This has concurrently declined our sales in automotive business by 26% in Q2 FY25 over Q1 FY25. We had already stated this earlier to you that we are keen to focus more on non-automotive businesses which can generate sustainable EBITDA margins. We have strategically and deliberately scaled down our automotive portfolio with focus on profitable contracts and building new non-automotive projects to replace unprofitable automotive businesses in the next financial year. It is challenging to state that Lumel Alucast reported subdued performance in this quarter compared to last couple of quarters due to challenges from auto industry, while non-automotive sales remain stable, which gives us confidence that we are on the right track. Moreover, we also aim for at least 10% cost improvement through optimization of our workforce, cycle time reduction, and logistics cost reduction in die casting business to bring the Lumel Alucast company back on track in the next 2 to 3 quarters. Over the past 6 months, we have consistently invested in R&D activities with particular focus on our China subsidiary, V&A, which presents promising opportunities for new product development. Recently, we designed and developed 100 ampere direct current energy meter, making a significant milestone. Our R&D efforts are ongoing, and we will share further updates as and when we make progresses. And also, we have successfully UL certified. This is for American market, UL certified a large range of our CT, which are manufactured in Rishabh Instruments, and also a top-end power quality analyzer, ND45, which is being manufactured in Poland with the UL certification. This opens doors for these products in American market. We are confident that these investments will yield strong results in the future. We have approximately 15 products in the pipeline to be added in the financial year 25. We target to achieve 10% incremental revenue from launch of new products in last 2 years. We also actively invest 1 to 2% of our revenues in our R&D facilities to innovate and design, develop new products in-house. With this, I would like to hand over to Vishal Kulkarni, CFO, to delve into financial performance of the group. Thank you.
Thank you, sir. Good evening to everyone. Our Q2 FY25 consolidated revenue stood at rupees 1,824 million, showing a marginal growth by 1.3% on a year-on-year basis. The H1 FY25 consolidated revenue stood at rupees 3,517 million and remained flat on a year-on-year basis. The consolidated adjusted EBITDA remained at rupees 137 million in Q2 FY25, which is down by around 64% on year-on-year basis. And for H1 FY25, consolidated adjusted EBITDA remained at INR 246 million, which is down by 62% on a year-on-year basis. The consolidated adjusted EBITDA stood at 7.5% in Q2 FY25 and 7% in H1 FY25. The consolidated PBT stood at INR 55 million in Q2 FY25 and INR 101 million in H1 FY25. The ESOP expenses for H1 FY25 stood at rupees 66 million, and we expect another rupees 48 million to be booked in FY25. Starting with the company-wise key financial highlights, Rishabh India, the standalone revenue for Q2 FY25 stood at rupees 589 million, down by around 6.4% from Q2 FY24, and for H1 FY25 stood at rupees 1,116 million, down by around 6.8% from H1 FY24. The standalone adjusted EBITDA stood at INR 105 million for Q2 FY25, down by 32% on year-on-year basis. For H125, stood at INR 181 million, down by 39% from H1 FY24. The standalone EBITDA margins remain at 17.9% for Q2 FY25 and remain at 16.2% in H1 FY25. For Lumen SA, our electronics business in Poland, it has achieved a revenue of rupees 557 million in Q2 FY25, up by around 31.2% on year-on-year basis, and achieve a revenue of rupees 1,055 million, which is up by 26.8% on year. The adjusted EBITDA stands at rupees 112 million for Q2 FY25, down by 8% on year-on-year basis. And for H1 FY25, the adjusted EBITDA stood at rupees 197 million, which is up by 10% on year-on-year basis. The adjusted EBITDA margin stood at 20.2% in Q2 FY25 and 18.7% in H1 FY25. For Lumen Alucast, it has shown a degrowth of 12.7% in revenues in Q2 FY25 and remain at rupees 584 million, and a degrowth of 6.3% in revenues in H1 FY25. Remain at rupees 1,278 million. The adjusted EBITDA stands at minus 82 million rupees in Q2 FY25 and minus 128 million rupees in H1 FY25. All other companies in UK, USA and China have grown by around 8.1%, 22.8% and 19.2% respectively in revenues, and have contributed an EBITDA of INR 5 million to the consolidated financials. On the consolidated level, we remain net debt free with a strong balance sheet. The net cash and cash equivalents as on 30th September 2024 stand at rupees 2,331 million. A healthy cash flow from operations is rupees 275 million, and the company remains net debt free as on 30th September 2024. With this, I shall now leave the floor open for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Aditi Sawant from ADM Advisors. Please go ahead. Yes, Ms. Aditi, go with the question, please. As there is no response from the participant, we'll move to the next. The next question is from the line of Rohan Vora from Invention Capital. Please go ahead.
Hello. Thank you for the opportunity. So, sir, my first question was on metering control and protection device businesses. So, basically, first half we've done around 152 crores of revenue versus 145 crores last year in the first half. So, what is it that is not allowing us to grow faster in this business, and how do you see the growth in this business going forward?
Yeah. So the metering business which we are having, it is contributed from Lumel SA and Rishabh Instruments both, which have overlapping products which we make and we sell. So this particular business is growing in India. We saw a good growth of this business in India, and also we saw a good growth of this business in Lumel, which is supplying in European market. So the export sales of this particular product to Europe is a decline, whereas we are doing good in other markets. So it's just the market economy in some parts which is affecting, but in a long run or in coming quarters, we don't see much of a problems with this product range at all.
Okay, and so do we expect the exports to do well, like going forward? What is your estimate on that?
Yeah, we need to increase our inorganic growth because market is market. So the strategy that we normally follow is when you have some of the economy is not doing good. So obviously, if we are banking too much on organic growth, then those clients, when they decrease, our sales also goes down. So the best option is to win more accounts to compensate for that, and winning those new accounts, and the quantity should be higher than that. That's the plan to have. We are engaged with a lot of opportunities, and we need to increase that.
Just to add to what Dinesh said, see, at the moment, Europe is not in a very good shape. All of you know that Germany is officially in a recession. The GDP growth is minus 0.2%. Spain is having a lot of problem, and our major customers in Spain, one customer has degrown by about, I would say, more than 80%, and he is the second largest customer. So we've had some this thing. So we have grown in other markets, we have grown with other products, but particularly Germany and Spain, which let us hope will come back, but it may be a couple of quarters before Germany and Spain come back. But Germany is in a real bad shape in terms of growth, in terms of GDP growth, and that is really affecting us quite a bit.
Okay, so specifically this business has higher exposure to the countries like Germany and Spain.
Yeah, that's correct.
Understood.
And alternatively, we are trying to increase these businesses in markets like America, UK, and also Middle East, and we are doing all of those. So what happens is when you have been supplying to some market for a longer period, your brand is established, and it's much easier to scale them up there rather than in a new market. You have to really establish your brand and take it one step at a time.
In America, we have really done a lot of work, as Dinesh said in his talk, that we have got UL approval on a lot of these metering products and CTs. And after getting the UL product, we have already seen the good things come, good orders come. But to really reach its full potential, again, will take some time. But US is becoming a very good market, both for current transformers as well as for multifunction meters.
Yeah.
Understood. And yeah, sorry, you're saying something? Yeah. So, sir, the next question was on the aluminum die casting business. So, how do we see, the revenue stabilizing going forward, and just a little bit more color on that. are we able to replace the business that we are losing, or how to look at that business?
Yeah. So aluminum die casting, we have done really a lot of work in the last 3 months. So it starts with a bigger scenario. The bigger scenario is the auto industry in Europe. So Volkswagen has got rid of about 150,000 people, and some 3 of their plants, which were 80-year-old plants, have been shut down some places, and many other things which are connected with the auto industry are closing down. So it's become a bit of a very high risk business. Not only us, everybody in that chain, particularly because of green policies of Europe, very aggressive green policies, I would say, of Europe, which are good, but the time that they have given to get them phased in out of taking out the other cars at the backdrop of competition that they have from China is putting a lot of pressure on these companies to come up with the electrical cars at a prices competitive enough with the Chinese cars, and so that has made the whole supply chain of car industry, particularly EV cars, distorted. So we were because a couple of 3-4 years ago we were so charged up that we want to be having this tailwind and go into these parts which are going to be used in EV cars. So we have really won some very challenging, nice projects. We are able to make those products, but at a cost higher than what we anticipated, and there were also external factors. So all this is the story, that this cost of manufacturing is higher than the selling cost. So we went back to all these customers, and 2 major customers we have. One of the major customers, we are doing about 15-16 parts, supplying to 5-6 countries. So we went with each one of those contracts. So each of those contracts we have agreed that they will be phased out in 3 months, 6 months, or 9 months. And during this period, we said that we cannot continue to supply with this price. We have to give us price increase. So whatever we asked, we have been able to get 50 to 70% of what we asked. So that's not going to take out all the losses, but it will mitigate a lot of our losses. So one is to mitigate the losses in the next 2 to 3 quarters when we are phasing it out, and also reducing the volume. So our mixture of automotive and non-automotive, which was 50-50 in our aluminum die casting, we want to bring it to 25 and 75. So while these are phasing out, we are engaging with non-automotive clients, and we are in some good negotiation with some of the contracts, so which will kick in 2026 or so. So we are at the final stage of some of the really good contracts on that. And then when these things will phase out, of course they will be having some losses, but reduced loss. And then we will plug in the non-automotive customers into that, and still we'll keep some automotive part, because you never know how the industries will go in the future. And we keep some of it, but only the profitable business will keep. This is the whole strategy. We started working on this, about a quarter or so now already. And to execute all of this, it will take another 2 more quarters to get out of this situation. And then we will start building. So at the moment, I would say the worst is behind us, the quarter which we closed. And now we should start reducing our losses and then get into a break even, and then kick forward. Whereas our volumes on non-automotive are intact, and they are profitable, but because of lot of these non-automotive products which are being run in our factories, so this also has some impact on the cost of manufacturing of them. So we want to really get out of all of this situation. There is a action plan going on to reduce the cost. So we were able to reduce about 6% of our workforce in blue collar in the quarter, and we have plans to reduce another 6% going forward in the next quarters. Then we have plans to reduce some cycle times, reduce internal scrap. So we have some plan which we are monitoring on a week by week basis too, and we are making progress. So the results are not visible now, but they will be visible in few quarters time.
Sure, sir. Thank you for the elaborate answer. I will get back in the queue.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Dhruv Pravani from Sriji Finance. Please go ahead.
Hi, am I audible?
Yes, you are.
Yes.
You acquired a SCADA business in. Could you share some light in terms of integration, where we are, and what would be our go-to-market strategy for the same?
Yeah. This is, we have these electronics products, and particularly the automation, industrial automation products which we have, where we have a lot of our transducers, then power quality analyzers, and then energy meters, etc. So we have got products, the hardware smart products, which can be IoT enabled, which have possibility to measure all the parameters and push all those data onto a system. So to connect all these products and to give a solution to the customer. So rather than selling the products, so it will be a forward integration where we are able to give solution to our customers on optimizing the processes, optimizing the energy, etc. And these system will be able to sit and integrate with the ERP systems of factories or operating shop floor operating systems, etc. So this is what this product is all about, and this product is ready, and it is a product which is time tested. It has been in the market for 35 years with a lot of revisions which have taken place. So the strategy is to take this product, make sure that this knowledge is precipitated to all our sales and marketing teams around the world, so that they can start selling this. And this has to boost our sale of our products and also sell this software as a standalone or integrate. That's one part of it. Second one is because we have got very high level programmers there. So some of our products, very high end power quality analyzers or other protection relays, etc., where you need to write some graphic user interface GUI, which you call as a GUI software, etc. So we have skill sets also. So these people can help us to in development of our products to a next level. That's the second thing which is there. Now it is very fresh. We have taken this company. Now we are in the process of integrating that. This is from Czech Republic, and the culture is little different, and we are all those constituting the board, supervisory board, all that is underway now. So once that is done, then we'll use that place as a technology hub and use all our Rishabh sales and marketing network to promote and sell this product more. So I would say it is one step going in a forward integration direction for us.
Thank you for that elaborate answer. So would any specific target market that you would be looking at for this, and in which quarter would you see the revenue start kicking in for us?
So this target markets will be definitely Europe and USA, and of course India also will be looking at for this market, because this is where you have automation is something as the energy prices are going up and cost of labor is also going up in every market, whether it is Asia or Europe or USA. So this is only can have more and more future and growth. Because it's just a matter of time. And once the basic infrastructure is put, people will be going for upgradation or modernization or automation. That's where this comes into picture. And very interestingly, this we can implement in lots of applications. It can be used in railways and infrastructures and call centers and in manufacturing industry, power generation, everywhere. So I mean, it is very versatile, very user friendly, and can be customized to different industries. So it's very good product.
Thank you for that. Just one last question. So global MNC companies like ABB Schneider have their own SCADA things and are well integrated in the B2B space. So are we going into different products, or how would we like to compete with them?
Yeah, it's a very good question. That's a challenge, and that challenge this company has been facing and has successfully managed that for 35 years. Just to give an example, they have this SCADA in one of the Siemens factories in Czech Republic, because it is so user friendly and good. So getting into that space is not so easy, as you very rightly said. So the people who are deep into using somebody's SCADA already, so it may take time, but this could be an ideal product to go for somebody who is just getting into that space. Small scale to mid scale companies which are looking for automation and things like that. We have a price advantage. Product is stable and been there in the market. Lot of flexibility and features we have. So we find that kind of a niche market. So if I'm going to trying to sell that in a big corporation, it's difficult, as you very rightly said. But because somebody is using some system, it's like somebody who is used to using iPhone. It's difficult for him to change to some other Android or something like that. So, but somebody who is not using a phone at all, so where I can go and try to sell this. So there's a lot of market like that for this.
See, today a lot of information is being gathered. Now we talk about storing on the cloud, we talk about big data, we talk about efficiency, efficient use of electricity. If you can reduce the consumption of electricity, it is as good as energy made, and plus it is directly affecting your bottom line. So these softwares, collect the data and do a lot of analysis. They will have data of last week, they will have data of last month, they will have data of last year, and then they will compare and they will give you specific ideas on what is to be done where. Not just general data where you go and analyze. The analysis is also built into the software. So this is where it will really come handy in terms of Industry 4.0 and making sure that your energy loss or wastage or this thing is reduced and you are able to really compete. See, today many industries like cement, steel, they are big guzzlers of energy. The major cost is energy cost, and if you can gather that data and compare between factories, between processes, between different times of the year, then that will be a lot of help to be able to optimize energy.
Yeah. Further to that, it's not only just giving some information and instruction to do. These systems can be programmed to do those actions. So they can be talking to the next set of equipment in the plant to take actions, like you have to slow down some process or shut down some of the processes to make use of the best tariffs, etc. So all those, again, AI can be built into that. There's a lot of space and research going on in this field.
Okay, thank you. Thank you very much.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. The next question is from the line of Aditi Sawant from ADM Advisors. Please go ahead.
Yeah, hi. Thank you so much for the opportunity. Just one question that, despite experiencing revenue growth across our electrical segments, what are the factors that are contributing to a separation of our margins? And if I understand correctly, is it primarily due to employee costs? Or, and if yes, then do you expect, this trend to continue in the future?
Yeah, I will answer that question. If you are specifically limiting to electronics business, even Vishal in his presentation showed the margins both in Rishabh as well as Lumel SA electronics business. Lumel SA electronics business margins were really good and top line everything. So it's not really have a role to play in that. When it comes to sales from Rishabh India, so we have 50% of our sales is happening in India, and which is growing at 10%. It has grown, and also we have decent margins, and these margins are better than what we compare the margins of last year in the domestic market. But our export business is down by almost like around 18 to 20%, the export market from Rishabh. So where we had bigger margins, and we are supplying some of those major accounts in Europe, which Mr. Golia also mentioned, in Spain and Germany. So those have dropped, and that sale had a better margin mix. So this is affected, and it is all temporary. We don't have anything to specifically alarming. And 1-2% cost increase which is happened is in in Lumel has been significantly high labor cost and other things, and we have been able to transfer that back to the customers. Similarly, in Rishabh also, we have some increase in the labor cost, and we have been able to transfer that to our electronics manufacturer and electronics customer. That's not an issue. The issue is that we lost some market in the export business, which we have to rebuild. So that's where the margins drop is coming from.
Okay. Got it. And sir, just one question, how long can we expect the impact of Alucast business going ahead? And if you can share any timeline, so that would be helpful.
Yeah. So as I very openly and transparently shared with you, that on these automotive businesses which are making losses, we found agreement fortunately with all the contracts that we have. With one client, we have decided to discontinue, and we amicably signed a lot of agreements to discontinue this. But for them to relocate these projects, some of them they are relocating it to China, most of them. They need time. So during this period, we asked for, say, on a part price of, say, something like 6-7 euro part price, we asked for 3-4 euros of increase. So they gave us 2 euros. I'm just giving an example. So that covers our losses significantly until this 3 quarters. So they want us to supply some project until we gave them 3 months notice, and that was not good enough. And 3 months notice is getting over in November, and they want us to supply for another 9 months. So we agreed to supply for 9 months, but we said that we cannot supply for 9 months at the rate which you are giving us. So we want you to give us whatever price increase we asked for. They gave 50 to 70% of what we asked for. They didn't give everything that we asked for. So, but still it will take away some of the loss. So during these 3 quarters, what we are doing is, so our losses will decline, and we hope that, and also we have some internal activities to reduce cost of manufacturing by 10% by reducing cycle time, reducing scrap, etc., etc. Unfortunately, labor cost and other things, inflation, we cannot control. So whatever is in our control, we have some plans to reduce that. But during this, 3 to 9 months time, we are also approaching non-automotive customers to increase the volume of that. And some we have got some success. We will be signing very soon one of the contracts which may take half of this vacuum which will be created. So another half we'll have to find during this period. We are sure that we will be able to find this. And after that we will have only maybe about 75% non-automotive portfolio, all profitable, and 25% automotive business also profitable, and then we should be making that journey. It is, this quarter has been the dip before we start picking up. So, and that picking up will also take some 3 quarters, 2 quarters for sure. 3rd quarter if we'll avoid, if we are very lucky, and then we go from there. That's how the things look at the moment. And there are a lot of actions in this thing. We know what is going around, and we are in control, and we are making actions to happen that. We also spoke last earnings call that we are engaging with these people. We will tell them either you give us price increase or take away the projects. So one customer agreed to give us a price increase, what we were looking for, and we will keep that and run it. The other customer was not willing to give what we wanted, so we made some compromise. We extended the time, and we also have some price increase. So this is how we are dealing with that. Unfortunately, these contracts, we have a lot of contractual obligations. We cannot just cut and go away because it is connected with the whole car manufacturing supply chain. And unfortunately, we are the only supplier for some of these customers. Even though they had alternate suppliers to develop, the alternate suppliers were unable to develop the technology and give them the parts. So in spite of being very at the forefront of technology and able to do a lot of things, but we are not able to get the profits out of that. So this is how the situation looks.
Okay, sir. Got it. Thank you so much for the detailed answer, and all the best for that.
Thank you. The next question is from the line of Darshil Javeri from Crown Capital. Please go ahead.
Hello. Good evening, sir. Thank you so much for taking my question, sir. and also thank you for giving such elaborate, detailed answers, sir. So, on a broad basis, from what I could understand, like for the next 2-3 quarters will be kind of a transition period where we'll be letting go of some auto sales and we'll be trying to replace it with the non-auto sales, and that might impact the margin. So any kind of like a rough guidance, like what kind of revenue maybe can we expect this year to be flat, and any guidance for FY26, what kind of revenue margins can we expect, sir?
So this year, at least on the aluminum die casting side, we are expecting it to be flattish, maybe a 3-4% increase to last year's revenue. And of course, the bottom line is not really good because a lot of damage has already happened in the 2 quarters, and third and fourth quarter we will be recovery mode. So this is how it is looking. But next financial year, we plan to get back to positive single-digit EBITDA at least. Around where the target is to get to 10% EBITDA on the aluminum die casting business. And the electronic side of the business, as you have seen, it is between 15 to 18% as we speak. So that we will still maintain going forward. So it's only the aluminum die casting. So we are reducing the volume of aluminum die casting business consciously, and also trying to increase the margins there. So this is how it looks. So next year our aluminum die casting should be around 30% of our overall revenue block. 70% we are targeting electronics. So last it was around 40% before. So 40 to 30 we are dropping there. And also this 30% will have single-digit EBITDA for the next financial year. That's what we are able to see now. And the remaining will be around 17-18% what we have always been projecting for the electronics. And that in fact is intact as we speak also.
Fair enough, sir. And so the electronic business growth in FY26, what could we expect from that, sir?
So we we have that would be in the range of 15 to 20%. So we have some setback on the export business. India we expect to grow around 15-20%. This is quite visible. Lumel SA also we are able to we are maintaining that because we do a lot of forward integration and value added activities there. US is a market which we are looking. It's a small base. Like just to give an example, from 1.2 million US dollars last year, this year will be 2 million US dollars. So it's kind of a big number. And also we are adding more resources for selling in US markets in the coming this thing. So we want to get it to around $5 million as soon as possible in 2 to 3 years time. So that's one growth area which we are looking at. And then we are also looking at China picking up. So this company was bought during COVID, and it was making losses. And this year, as we speak, we will be we'll make a break even on that. And so we launched that product in India also. So there we are looking at some good growth coming through. So we have I think we 15 to 20% very easily we should get.
Oh, okay. Fair enough, sir. Yeah, that's it majorly from my side. Thank you so much.
Yeah.
Thank you. Ladies and gentlemen, due to time constraint, I will take this as a last question. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Yeah, Dinesh, I'll tell in brief. See, electronics last 20 years has always been a very good growth business. We have our own brand, we have our own customers, we have our own price list, which we can adjust to the input cost increase or decrease. Aluminium was a different business. We serve our customers. Even there we made profits consistently for the last 5-6 years. This year has been a real challenge. But I think for the experienced management that your company has, we will be able to come out of it. A lot of plans are there. Nearly every week there is a extensive discussion on what was the plan, what have we achieved, what remains to be achieved. So I know all of you are worried. As management, we are also worried, but we have definite plan to come out of it. So in spite of what happens, India, of course, everybody knows is on a growth path, but Europe may not come, even next year, it may not come on a growth path. But in spite of that, the electronics business will grow well, and the aluminium we already bottomed out, and now we have to make sure that we come to first for zero, no profit, no loss, and then come back to the 10% EBITDA which Dinesh talked about. So that is from our side, and let us see what time brings to us. Thank you.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.